Okay, Vinny, we'll leave it at that. Let's get on board Karan Taurani from Elara Securities and find out whether he's got a buy on Nykaa and what is it that he's doing with Zomato. Karan, hi, afternoon. Good to have you on the show as always. Let's first start talking about, the kind of move that you're seeing on Zomato and the kind of commentary that you've heard from the management. Exactly what the market wants to hear. But do you buy it, or do you think right now what you're seeing is just a very sentimental knee-jerk reaction on the stock? Is it sustainable?
Hi, Aisha. Good afternoon. Pleasure to be here as always. So firstly, I think in Zomato, I think if you look at the revenue growth, there is a slight disappointment here. I think if you look at the sequential growth in terms of Q on Q over the last 3 quarters, they've been growing at almost 6 to 7 odd percent, and this quarter has come at about 3% in terms of GOV. So I think there is a disappointment there, and clearly there's an intention here that they don't want to focus on low quality growth as highlighted by the management. I think, on a steady state, what we see right now in terms of GOV or in terms of the food business revenue, we are going to move towards the 25-30% kind of a revenue growth, which I believe, is kind of satisfactory because, 40% kind of growth rates plus were not sustainable because eventually they would have a negative impact in terms of your EBITDA margin. The good news is that, contribution margins are right now at highest ever levels of 4.5%. They were at similar levels, at the peak of the pandemic as well. And the management has clearly guided, I know this will move towards 8% going ahead, and which means that the EBITDA margins as a percentage of GOV will move towards 3 to 4 odd percent. So I think that is a good news in a way because now we can value this company on an EV EBITDA basis. There is a clear roadmap in terms of the path to profitability. We are seeing a lot of marketing expenses cut down. In fact, if you look at marketing expenses as a percentage of revenue, it's actually half, from a 38% number towards 18% number currently. So I think this is a good move where, they are trying to focus more on profit right now rather than revenue. They don't mind, probably, losing that 7-8% of revenue growth if it is coming at a very good profit margin number. So I think there's a clear shift in terms of the intention. I think one big monitorable here would be the losses in the emerging businesses. So if you look at the quick commerce and hyperpure, they're still making losses over there. So Zomato, the food business, might end up getting a very good number in terms of the absolute EBITDA over the next 2-3 years. But if the losses of the other businesses are at same levels or if they continue to magnify, I think eventually it will hurt the overall valuations of the company business negatively. So I think that is a key monitorable in terms of how the losses for the emerging businesses converge because the competitive intensity, specifically in the quick commerce business, is very high and it is more discounting led for now as most of the companies are penetrating deeper into new markets.
At what point in time markets would start getting worried about the growth factor? Because now growth is intact, but markets are focusing on profitability. At some point in time, markets would say, okay, your path to profitability is defined, let's go back to growth. And that's the time the challenge comes back because to grow, they'll have to burn. And if they don't burn, growth's not going to be there.
Yes, I think absolutely. If you look at the growth this quarter, it's been about 30 odd percent. But, because the marketing expenses have come down so sharply, the growth might even go lower over the next 2 quarters if there is a structural issue of, always chasing growth at the cost of, burning money. So I think the monitorable here is that I believe that growth eventually, should not slip below 25% on a steady state CAGR basis. I mean, you could have a quarter up and down, basis festive or non-festive. But broadly, I think 25 to 28% kind of a CAGR growth in terms of either your GMV or in terms of the food revenue is something, which will be a key monitorable because if the growth were to slip below that, then I think there's a concern in terms of the valuation multiples as well. Because if you look at the traditional QSR companies today, even they are growing at almost about 18 to 20% kind of a number in terms of revenue. This is obviously led by store expansion and SSG growth. So I think, Zomato being a food tech company getting such premium valuations versus traditional companies, the growth has to be at least 25-30%.
Karan, we'll let you go on that note. Let's see whether that fructifies or not. But definitely the stock is excited and penciling in better growth.